Let's talk a little bit about where the tax equivalent yields are in high yield munis as compared with comparable yields on high yield corporates.
Yeah, thanks for having me. I think this is a fantastic opportunity for most investors right now, especially, as you said, as people start thinking about their taxes and where the best tax efficient opportunities are. Just for some context, when it comes to where people are positioned today, we've seen almost $1 trillion in flows into parts of the fixed income market, into cash assets in the calendar year 2023. People buying bonds, treasuries, money market accounts, and so on, to try to get some yield, but also to, I think, prepare for the risk of recession which didn't occur and is certainly not our expectation at Bank of America. That means that you have a lot of investors right now who maybe weren't in the fixed income markets or weren't in treasury bonds until very recently, who may find when they pay their taxes this year, there's a pretty significant drag, big hit from those tax rates. High yield munis in particular and municipal bonds generally are really attractive for those tax efficient, tax advantaged yields. So for example, right now, some of the high yield muni ETFs we like, ticker symbol HYMB or HYD, are two examples in our research coverage that pay you about 5%, and on a tax equivalent basis for a high income earner are yielding, you'd have to buy something yielding 8% to beat those yields on those high yield muni ETFs. We think that's an attractive opportunity right now.
And if you have to go out into the market and you say you to beat the tax equivalent yield on a muni by going into the taxable marketplace, I would assume that you're taking on a much higher level of credit risk.
That's exactly right, and that's another huge advantage we think in this market. The fundamentals in the municipal bond market, state and local governments and other issuers, fundamentals are very strong. And my colleagues across Muni Research have confirmed they call this a golden decade for the municipal market, given the strong fiscal positions that many of these issuers are in since COVID. And to get an equivalent level of yield in the taxable market, you would have to go out into BB or even lower rated debt in the high yield corporate bond market, debt levels that would have much higher default rates in any future economic stress scenario. So our sense of it is that a high yield municipal ETF can give you the equivalent yield to some pretty risky high yield corporate bonds, but with much lower expected stress or risk levels in the case of an economic problem.
More yield, less risk. The one thing, among the few things I know about munis and fixed income is this. The one thing you need to watch if you buy a fixed income ETF or a mutual fund is that it's not merely the yield that you should be paying attention to. It is your total return. And if interest rates go up, your total return, the value of your shares, your fund shares, goes down, correct? So what you make in yield, you might give up in total return in part. Walk me through that, assuming that interest rates are going to come down. Not only would you get this yield benefit, but you would also get the booster shot of higher capital values.
That's right. There's a potential for some capital gains, some price return in the kind of scenario you mentioned. That's not our core case for the reasons why we think these are attractive investments. But it's true that investors who have been, as I said at the beginning, positioning for rapid declines in interest rates in a recession or a rapid rate cutting scenario from the Fed have plowed money into treasury bonds, into money market accounts and other higher yielding cash accounts. And we think that the time is right to move out of those maximum safety types of assets into parts of the real economy where you can get an attractive yield with an attractive level of risk, but not be making this kind of one-way bet on the future path of interest rates. Because what's just as important about these high yield and other muni ETFs is that they're connected to the real economy. You're taking a little bit more credit risk, but in return, you're not making all your fixed income portfolio one giant bet on the future path of interest rates and of inflation. And given how sticky inflation has been, given how uncertain I think the path for interest rates is going to be over the long term, we think that moving out into the real economy in your fixed income portfolio is a really smart thing to do.